How do you make sense of it? Supply is up, leverage is higher, the debt pile is heavier, and yet credit spreads are tighter, Mark. Why?
Hi, Jonathan. Well, I think what's really happening here is that we're starting to improve. If you look at the economy, we've added 9.3 million jobs in the last 3 months. We've seen mobility data improve. You're seeing that in air traffic. You're seeing that in hotels. And most importantly, Jonathan, it's really been the central banks. It's been the government putting in $2.9 trillion of fiscal stimulus, and then the Fed, which basically has expanded the balance sheet by almost 20% of GDP, unprecedented. Importantly, putting in place on March 23rd the corporate bond purchasing program and expanding that to include fallen angels. So the Fed so far has basically bought about $12.4 billion of corporate bonds. They've only used 5% of their total secondary market corporate facility. And yet by only using that $12.4 billion, they've crowded in the private sector, and you've seen $1.3 trillion of investment-grade corporate bond issuance year to date. So the central bank has effectively crowded in the private sector, and it's been unprecedented in terms of the support.
Mark, did you ever think we'd sit here talking about a 10-year issue, 10-year paper from a junk-rated company, south of 3%?
We didn't. I mean, on March 20th and on March 24th, as you recall, we've spoken about this. You know, we were extremely bullish on credit. We called it a 9 on a scale from 1 to 10. And today, frankly, it's about a 4 or a 5. So no, these yields are very low. But let's not forget, the reason why the yields are so low is it's a global supply and demand for income. Yields are 0 on 10-year government bonds in Japan. They're minus 48 basis points in Germany. And the reality here is that inflation is coming down, and so there's no chance the Fed is going to raise rates for the next 1 to 2 years. QE is going to continue. You're going to see the central bank continue to expand. The central bank, by the way, in the United States is buying at the pace per month 80 billion of treasuries and 40 billion of mortgages. So all this fiscal spending, the Fed is basically just buying the treasuries to offset it. And that's why these yields are so low.
Mark, I'll ask a question that on the surface might sound a little bit crazy, but I just wonder whether credit ratings actually matter anymore, Mark, and whether the difference between investment grade and high yield means anything to anyone anymore. Mark, what are your thoughts on that?
No, credit ratings matter. I mean, a third of the time, Pimco rates companies very different from the agencies. Forward credit fundamentals are essentially where credit spreads are going. And so there are a lot of these industries that will have a very fragile recovery, many of these cyclicals. And so while you want to be constructive on markets, given the amount of central bank support, given the amount of fiscal stimulus, the mobile data improving, you also want to be somewhat defensive in terms of what you buy, because the credit fundamentals are deteriorating. In fact, they have and were deteriorating even going into this crisis for many sectors like autos, energy, retail, chemicals. So active management is a big deal today. And so we are finding the credit markets appealing and interesting, but we're doing it very selectively.
So to be clear, Mark, you said this up front back in March, April, that you didn't want to have anything to do with the cyclical areas of this market. You were talking about energy, autos, retailers. Are you expecting dispersion to persist, or are you expecting any kind of conversion through to year end?
So I think what's been remarkable, Jonathan, about this market is the huge outperformance of tech. People are paying up for growth, and people are paying up for high-quality balance sheets. Whether or not that reverses is really going to be predicated on mobility and the virus. So the sectors that have been really beaten down a lot have been travel and tourism. You look at the airlines, the lodging, the gaming sector. As economies start to reopen, you actually could see a pretty sharp recovery, and we're seeing that today in airlines, in hotels, in gaming. Macau overnight, by the way, has relaxed visa restrictions. So as basically these global economies start to reopen, the next wave of the trade could be the recovery in the travel and tourism industry. And I think this morning really highlights the beginning of the potential for that to happen.
So, Mark, the key question this morning then, and I think it's clearly too premature, but I'd love your thoughts on it, is whether we've seen the low in real yields in America.
Well, I think ultimately we are, Jonathan, going to get a recovery. And granted, it's not going to be a V-shaped. It's going to be an L-shaped. A lot of government policy in the virus is causing the recovery to be slow. But these real yields are exceptionally low. And I think that's why gold prices are going up, and that's why equities, particularly tech stocks, are going up. So I think we're close. But ultimately, it's going to be very dependent upon social distancing policies and mobility, and that will ultimately, the virus, determine the outcome.